All right, welcome to the first episode of Real Estate Chat 2023 edition with Jonder Perez and
Robert E.
welcome. So in our last episode, we gave you predictions or our thoughts on where the market may be going in 2023. So that was a week ago, right, Robert?
Seems just like a week ago what it was a year ago.
Yeah, you know what, you're right. It was a year ago. And today, what we're going to do is talk about perspective. And the reason why is because the real estate market is all about perspective, right? I mean, in terms of what the media is telling you, what the Toronto Real Estate Regional Real Estate Board is telling you, what realtors are telling you, what everybody else is telling you about it, and all of their opinions. It's all about perception. And buyers and sellers and investors of real estate act on what they feel may happen with the real estate market based on perception of data and information. I'm going to go really quickly through the Toronto Regional Real Estate Board market report, the market watch that is published every single month, because this is where the data comes from. Everything that is derived from, or everything that Robert uses in his charts is derived from Toronto Regional Real Estate Board data. I'm going to show you that Toronto Regional Real Estate Board market watch, go through some of the big numbers that they talk about, and then Robert is going to give you perspective, a different way of looking at things after you've seen these charts. Let's start by looking at the Toronto Regional Real Estate Board's market watch for December 2022. So just quickly at a glance, because Robert's going to go through this in much more detail, basically the information that's available to you and to realtors, anybody looking at this report on their public website, sales have dropped year over year when you're comparing December figures, 2022 to 2021. Sales have dropped 48%. New listings have dropped 21%, but that's not an accurate number, as Robert has talked about with the cancel and relist reports that have been published before, but were not published as of the point of our recording today. Active listings up a whopping 169%. Is that going to be a big concern? Robert's going to answer that question in a few. Average price has dipped 9.2%, even though for the year, you're going to find out that it's actually up by about, 10%, Robert, that the final price has gone up year over year?
Annual price of 2021 and the annual price of 2022 increased by 8.6 something or other, but that's like comparing all year temperature to all year temperature.
Right, exactly. So there's a big difference between month to month, year over year comparison versus averaging the entire year's comparison. So you're going to hear about that in the news. Up by 9% or down by 9%, what's really happening with prices. Days on market, whether it's listing or property days on market, have increased. So you're looking at about 27 days for a listing, 40 days for property days on market. I'm going to zoom right to the last page of this because this is really interesting charts to look at. And when you're looking at the final sales figure for all of 2022, you're looking at 75,140 trades within the Toronto Regional Real Estate Board or transactions. And when you're looking at 2021, you're looking at 121,639. And this is what Robert was talking about when you're looking at the average of all of the prices for 2021 versus 2022. You see it go up by 9%. Meanwhile, it's dropped 9% on a year-to-year basis when you're looking at it simply from the perspective of the month-to-month comparison for the year. So, Robert, we're going to load up your charts here.
Okay. I devised this chart that you're looking at as a school year, like a fiscal year, starts on September the 1st and goes to August, because that's how the real estate market actually works. And what this one does, you can see the "we are here" arrow, points to the seasonal low that occurs every year in December and January. So that's where we are. And this approach, this school year, accentuates and shows, rather than being at the two extremes, it's now concentrated at the center. So you see there's a fall rally and then the seasonal low. Then we go into a spring, and the spring sometimes has huge, well, you can, that's why that huge array is there. And the whole idea is to gain perspective by looking at the 10-year point of view. In this case, we have a chart that says, oh, gee, we're having a lousy year, as it starts in September, all of them are right below everything else, those green X's. And yes, indeed, same as for the last several months, that instead of getting anywhere near 4,800, which is the 10-year average for December, we're 36% below that. But we already knew that. But this just shows it to you. It shows the whole year slightly different. If we go to the next one, we see the regular January to December year. And what this also has is that little orange box up on the top corner that says part of the price is the array of sales that are being sold, the selection of housing types that are being sold. In the top category in the board breakdown is $2 million. And so there was 183 sales in December, which is 5 point something or other percent. The 5-year average for December is 4.5. So it's a little bit ahead of the 5-year December average. And so far this year, there were nearly 6,300 sales over that price point, which was 8 and a bit percent. So the high prices were earlier. Now we're a little bit below that. The rest of this chart, unfortunately, tells us down in the bottom corner that it was the 24th best December since 1996. And we see 1 year on there, 2008, which you all remember as being a very lousy, terrible time. The financial global financial crisis was worse than the month that we just had. So we don't need to look at that one anymore because it's depressing. If we look at prices, this is again January to December. There's that same $2 million. We have those big stars, red stars, have broken down through the previous year. And we looked at this last month, and yes, it's the same. Year over year, we're down 9%. Now, the next chart, I think, shows more than this annual chart does. This is a 2-year chart, and it goes back to this school year, starts in September and moves through. In this case, on your left-hand side, there's 1, 2, 3, 4 big stars, sort of in a taupey purple, and that's the last couple of months. And over on the extreme other side, in the same kind of star but in red, is the tail end of the previous year. Now, what's that showing is a 2-year change. 2-year change eliminates the sort of year and a half from the fourth quarter of 2020 through to the first quarter of 2022, and the black line below it, it seems to be tracing it. And so 2-year change of around 13% is really where we are. The aberration, the anomaly was the year that we had in between, and that was almost 100% fueled by 1.5 to 2.5% first mortgage rates, which is just impossible to have and unsustainable, and we know that now.
So quick question here, Robert. So
yes?
quick question here. So we're
Yeah.
looking at, this is where we're at today. I mean, January is going to appear somewhere here, but because last year's numbers were extravagant,
Yep.
we're going to see, I mean, a significant difference. And what the spin on this will be from the media, it's like prices have dropped significantly. But can you comment on when you're comparing it to these high prices, the upcoming January, February, March, maybe up to all the way till April, even May?
Yep.
What kind of perspective should we have in terms of what we're hearing about price drops versus the reality of a normal movement in price?
Okay, very keen observation. This month, the Toronto Real Estate Board changed their format to downplay the month over month, year over year, same month last year format, to push the annual price compared to the annual price, which we never do. Who cares? What, you push all 12 things together and you get an average, and you push another 12 things to get an average. Who cares what that is, except it's an up. It's a plus and minus rather than a negative. So you can't fool anybody. Just like when the Royal Bank or this week LePage came up with the things, Phil Soper, who I'm sure he just had some underling, put it together. You've got the Canadian price. He thinks is going to be up by 2% at the end of next year. Now, I guess everybody doesn't want to be wrong. They don't want to overstate something. They don't want to be seen like a real estate shill. But to answer your question, the bulb, the bump, the boom, the bubble that we saw in the early part of last year is going to, and here's a new term, anniversary out, meaning that it's 1 year going to pass, but 3 months it's going to pass, it's going to pass, it's going to pass. So it's going to go away. There's going to be tremendous differences. And that's why I feel the value of this 2-year price change is more significant than the 1 year. Just like anybody can be what I used to call salesman of the month on a given month. You have a huge sale, or your brother buys 3 places, or who knows. Anybody can be salesman of the month. But if you're number 2 every single month, then you're salesman of the year, salesperson of the year in the modern vernacular. So that's why this 2-year look will give you a better perspective. And that's why I push all the time the 10-year perspective. But what does it normally do in December? What does it normally do in June? And never mind this seasonally adjusted crap. That's, my head is in the refrigerator and my feet are in the oven, but I feel average overall. It's a misdirection rather than an insight.
So when you're looking at basically, I don't know if you'd call it the outliers in terms of where the price lands, or basically the extremes, it happens because of an impetus such as low interest rates, just a pandemic, and in terms of just everybody wanting to purchase property, causing an already low inventory level to become even more competitive. And so this is not really a normal way of looking at it. If you're looking at Robert's charts from previous years, you see that the price movements on a year-to-year basis are almost predictable until they started to become more exponentially profound leading up to 2020 and then into 2021.
Right. If you go back to the previous one, it shows it more perfectly that this is January, February. And so there they are all lined up, 3-5% of top, right from the bottom, going back to 2001. I think the first one is 2002. And they're all lined up like a pancake. And then all of a sudden you get a craziness in the exuberance we had in 2015, where we had double-digit year-over-year price increases in 22 of 26 months, and then the exuberance that we had from December of 19 through April of 22, where we had double-digit price increases in 27 of 29 consecutive months. No, those weren't consecutive. We had 2 years of lockdown. So yes, we need perspective. We need to pause for the cause. And
let's look at active inventory, because we did see a bump now in inventory year over year, which was expected. I mean, it's not supposed to be a surprise. After historically low or relatively low inventory levels, we're now at 86.92 as of December. So what's your perspective on this, Robert?
Okay. Last year and this year is too skinny a slice of time to make a reasonable assumption. If we take the 10-year look, which is what this does, you've got a red line dotted and a black line dotted. One is the 10-year average at 9,100 and the other one's at 8,500. And we came in at nearly 8,700. So we're right smack in the middle. We're right on target for the 5 and 10-year average. The only thing was last year, everything sold, like everything sold. And like nobody puts their property on the market in December. Nobody. Maybe put a rental property on or something that you've had on for sale for the whole year and it's empty and you got to dump it. But so the inventory was piling up to what would be normal. And this huge increase that it shows is an artificial look. The long-term look is what tells you what's going on. Because if we know that there's not a glut of houses, and if we know there's not a glut of buyers, then how can listings go up by such a huge amount? And what does that mean? It means absolutely nothing, except for the year that they're comparing it to was very low.
All right, let's look at days on market now.
Okay, days on market. This is very interesting again. Listing days on market means when a property sells, it's for a contract period of time. And there was 27 days expiring on the average one that sold. Now, property days on market means for the very same ones that sell, if you add up all the previous iterations of that listing, perhaps with the same firm, perhaps at a different price, for different market strategy, and you add them all up, then you get a perspective on what it really took to sell that property. So here it means that if a property sold, it took 48% longer than the first listing period for it to actually sell, because only the ones that sell get included in the statistics, not the ones that are just on the market. And so I'm going to say that this is an indication of people who try it at one price and then cancel the listing to get rid of the history and put it on again. This is their dreaded terminate relist. And 40 days is not a bad days on the market. Like you have a 90-day listing on purpose because it takes 67, not 85 days to sell a normal property in a normal market. We're used to having 10, 4, 14 days on the market as an average. So this is showing the trend. We're much above the 5 and 10 year average, much above, but
again, it's just a matter of, again, using the word perspective a lot. Perspective as a word had royalty as well. Basically looking at it as we were used to seeing 10 days as normal. And now that perspective has changed to seeing it take a bit longer to sell, but longer to sell is actually closer to a normal time. Like, I mean, a house that sells in 10
what this does, those average numbers, those average dots are for the same month. It's only December's. Whereas the other ones that we're seeing is every month in the course of the year.
Exactly. So, yeah, this is homes are taking a bit longer to sell from 10 days, 1 day, 24-hour sales, but basically this is what a normal expectation of homes to take would sell. 30, 45 days on the market, 40 days property day on market. So let's talk about percentage of sales, MLS sales as percentage of new listings. So the sales to new listings ratio, where Robert's favorite cancel relist or net new listings.
Right. No, they haven't put the stat out, which I had to guess at 25%. And so 25% is 10, 1,018 listings as relists. So that may be wrong. The interesting thing here is you've got the two parallel azure lines talking about over a seller's market and buyer's market. And then you got the da 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 da, which shows the average. In this particular month of the year, December, it's always very high, as indicated there in the 5 and 10 year, like 100%, 105%, because there's a certain number of sales all the time, particularly in the last 5, 10 year period. There was a boom. Within the last 5, 10 years, there was a boom the whole time. And so with diminished inventory and continued sales, then the ratio of those that do sell will go up so that they almost equal. That's why it's 100%. The month that we just had, if you use the standard method, it says it's 77%. Now, 77% is normally excellent. It's well into seller's territory, but it's way, 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 way below what it should be of 105. And our net new listings, where we're guessing at 25%, comes in at 102%, which is darn close to the 5 and 10 year average. So we're taking an anomaly out or a factor out to come up with the true number. So we'll see what they put out, but I think it's probably going to be pretty close to 1,000 as the relists for the month of December.
Absolutely. And we talk about this in the previous videos. If you want to watch that, make sure you check out our channel. Make sure you like, click the thumbs up, click subscribe, put in your comments and the questions. And, you know, do you agree, disagree with what we're talking about? What's your perspective on this? Make sure you interact. And thank you for those of you who are keep watching and subscribing to us and are also commenting. Let's look at the TRREB. It's also, this is from Toronto Regional Real Estate Board's comparison for the past 4 years of the sales to new listings ratio. Robert.
Yes, this is what they put up last month. They'll do another one. I was expecting it any minute. And you can see December, the last bar on the right-hand side is way high, way higher than anything else. And it's just the peculiarity of December of very few listings. Nothing new gets put on the market, but continuing sales. And so the ratio is very high.
And let's look at, yeah.
Sorry. This chart is my search for what's going to happen to the market in the future. I believe that buying a house is largely based on monthly payments. And so I took an old number from 1990, at the time when there was 13.5% financing, but prices were much lower. And the monthly payment to carry a 75% loan, I used 75% then and now because that's all you could get as a conventional loan in that at that time, and came up with $2,140, and then adjusted that almost to double it to allow for inflation, the inflation that's happened since then till now, to come up with a number of $41,4740. The monthly payment for a purchaser And if you take 4147 at 7%, 6%, 5%, 4%, 3%, 2%, the various factors, you get a certain amount of mortgage financing and a total purchase price. So at 7%, that means you could buy a house for that 4147 with 25% down at a little bit under 800,000. And if right now we have mortgages at or somewhere around, let's call them somewhere between 5 and 6, that would work out to an average or to a purchase of somewhere between 850 and 950, 900. And if we get 4% financing, then it comes out to 1050. And surprise, the average price this last month was 1050.
So it just makes sense. I mean, in terms of affordability, in terms of mortgage interest rates, the amount of money you're paying to borrow, well, the amount of interest you're paying to borrow money dictates what the price of home you can afford and therefore what the price of homes should be.
It's all about monthly payments and down payment and also closing costs, because that's part of in Toronto where you got the double land transfer tax, huge amount of money. It's all about monthly payments. So where we're going to go to next in talking about what should you do as a buyer, what should you do as a seller, is try and make special arrangements with the seller, because mortgage lenders aren't doing it yet, about reducing the monthly payments by having the seller do the financing and have the seller contribute to the financing. And we can talk about that later. But this is the magic formula, all based around monthly payments. And you can dispute whether I got the right starting point or the wrong starting point, but that's just how the math works out. Now here's our also famous, wildly improved derivation of a chart from Robert Hogue of the Royal Bank, who put together the last 5 peaks of real estate activity and put them all as 100% on a chart and then compared them. So you can see the variation in time on a percentage basis. So we're red on this one. We ran up as fast as anybody, came down as fast as anybody, and now sort of dithering around. Toronto Real Estate Board, in their blurb, I guess their teaser to get you to pay attention to today's results, said that the market was showing signs of bottoming. So I guess that means the dip down that we've seen is a bottom, because it's broken through this magic 80% line. And I hope he's right. He might be right. Any of these other markets were not the same as now. And I think also that we're only at the beginning of this market. That's why I put the continuation of the one I think, 89.90, for so far into the future, 7 years, because I think we're going through a grind here. We're going through a grinding machine. We're going through a meat grinder that we've just started to get into.
Do you think it's going to repeat? Do you think we're going to see this pattern here, this dip here, continue the way that it did in the late 80s and 90s?
Well, okay, that goes down to just a little bit more than 70%. All the jazzing around doesn't matter. It's the 70%. Right now, we're already 80%. We broke down to 79%. So we have 7 years into the future where the previous indicator gyrated around and worked its way down another 10%. We've already come down 20. So we'll see. What do they do with interest rates? How badly does the government put pressure on the Federal Reserve and put pressure on the Bank of Canada to undo what they've done? We talk about pivot. We've talked about pause. We hear about all these all the time. They're trying to get interest rates to be greater than the rate of inflation. Now, the next thing they'll do is going to cook how they calculate the rate of inflation so they'll be able to fiddle around with it. But you know yourself, you don't want to have your interest rates to go up. You don't want your monthly payments on the renewal of your mortgage to go up by 3%. You just don't want it, because you had your budget set on here. Now it's going to go to here. You don't want it. So the ramifications of what they did last year by increasing it 200%. It's only 4%, but it's a 200% increase. The payments, it's the payments, it's the payments. The impact of that will not be felt, at least until the end of 2023 and maybe longer. So nobody can say whether we're following that same graph or
Time will
whether
tell. Really depends on what happens with the government policy on interest rates and other factors. Yep.
that's right. So this
Now,
is the sideways, where just if the average so far from February to today is averaging down of 2.12%. And so you can see that most of that came right at the beginning. And so our top line there, we saw in February 21, July 21, the same price of 1051. I guessed at it based on the averages of the 20 of the last 21 years falling. Every single December is lower by 2.48 or some other percent than November. So nothing special there. That's what happens every year. The average price, again, like Mitch Corman said, it's only the houses that sold. They get thrown into that average calculation. That it's not an overview of everything. It is an indication of where the activity is. If the activity is at 700,000, it's going to bring the average price down under $1 million, but it hasn't yet. Which brings us to the next one. Where are we? And this is plotting the that amber line or whatever color it is, the fixed 5-year rate. Nobody pays the posted rate, rather posted rate. Nobody pays that rate. Everybody pays the discount rate unless you don't have perfect credit. And what happened in the past? You can see it in 1981, it went up to so high. And this is Paul Volcker. And so the current guy that's in the Federal Reserve now, they keep on talking about Paul Volcker. He raised interest rates so high to kill inflation, and then he relented, and then he had to do it again because he didn't beat inflation. And that's what we were talking about in 1989-90. And the blue lines are the average price on an annual basis, increasing, and then adjusted by inflation, increasing. So I've got those down arrows. Are we here now again saying it might be softening of prices for some time if we are there again? But there is no parallel. Back then,
even when they, so I mean, this is obviously pointed out in the chart, but even when they decreased the interest rates, I mean, reflective of the mortgage payments that are made, prices were still dipping, but that's because of the continuous effect and adjustments. So even if, like, I mean, I know a lot of you are anticipating, will they reduce interest rates in 2023? How about in 2024? Even if they do that, Robert, will we still see, similar to what happened in the early 90s up to the mid 90s, will we still see prices drop even if interest rates go down?
Okay, two answers. One is no, because it depends on the property. What we have is individual sellers and individual buyers. The other answer is yes, on average, because that's the trend. People are saying, I'm the buyer. I don't like the interest rates. I will buy your house if you help me out. Help me out by selling it to me at a lower price, or help me out by giving it to me at a cheaper rate of interest somehow that you have to pay for. And so that's what happens. In this case, it was a grind that lasted for 7 years. I have a feeling that they're going to relent this time after 2 years. Everybody talks about next year. Who knows what's going to happen next year? But right now, the Federal Reserve and the Bank of Canada seem to be pretty firm in saying we are going to keep this. Perhaps we won't go as fast up, another 0.75, but they're going to keep that until they can show with hard data that they have beaten inflation. Now, part of this was transitory. That part of it was costs that were increased by retailers because they could. Part of it was increased by transportation companies because they could. Other was increased cost for gasoline to bring something from Florida over. Yes, it went up. And we're gonna anniversary out some of that so that the annual change, which is what they talk about inflation being the annual change in a price. And the thing that's not included in the CPI is quality. If you used to buy something made out of steel and you paid $1 for it, and now you get it made out of plastic and it's $1, it's 0% CPI because it's the same thing, but it's not. The quality's gone down. So, and again, the whole today is perspective.
And the key takeaway here is that if you're hoping that you're going to get prime property or a premier property lower just because that's what it shows on the average, well, the answer is you're still going to be, it's still a competitive marketplace for good properties, for great properties. And so you shouldn't really wait and see what happens. If you're in that, as Robert always points out, if you're in it for that one property that's going to make you live in that particular neighborhood, have your kids go to that school for the next 5-10 years or whatever. And if you're looking at that, and if you're waiting on the sidelines just to wait for that property to price down, there's still competition out there. And so you may be disappointed in this spring market if you're rationalizing the wait and see approach because prices will continue to dip. Yes, they will dip, as Robert said, on average, they will dip. But that really nice property may not follow the same decline, right? It will still be competitive for that. So let's bring it to
And this
here.
something that's far too small, but I think I put into a simple format of saying, if you bought the property at, this is what compared to what at the very top price, $1.334 million, and got a mortgage for the whole shoot match at 2.84%. Everybody thinks that would be nirvana. But just like the old dogs were saying to us, or the old pros were saying to us, while the prices were at the peak, saying, don't wait for the prices to peak and fall down, because if they fall down, it's going to be because interest rates are higher and your monthly payments will be higher. So this is a long, complicated thing that can't be explained for the general case. It's got to be specific, but it's an example of what's the purchase price, what's the down payment, what's the monthly payment, and what kind of a position are you in 5 years? It's assuming that you take a 5-year mortgage after 3 years, 2 years, whatever it is, the term that you take, and you compare what's the seller probably wants, what dream come true he might have got a year ago, and then based on 2 different options of how you could finance it, how you could ask him to finance it, can you make a deal at a price that suits the seller, a price that suits you, and monthly payments that make you happy? And so this is the service that we offer in interest averaging and in creative mortgage financing, that everybody knows how to do math, but not everybody knows how to apply it. And that's what John and I are all about.
So on that note, Robert, in terms of our perspective, thank you so much for sharing that with us as far as taking the data from our local real estate market here in Toronto and making sense out of it. So being that it's what day is it today? The 5th day of January. And
Only 5, yep.
only 5 days so far. And we typically get a pulse. So, I mean, I was at the office Tuesday of this week. Parking lot was full. Real estate agents are working, and the real estate market is going. And in terms of the direction that the market will take, we will likely see in the next 2 to 3 weeks what the pulse of the market is. And so, any advice for right now, the seller that was contemplating entering the spring market, they obviously didn't list it last year. They certainly didn't sell it at the peak. So what's the strategy now for a seller?
Well, I said the same thing a week ago. If you want to sell your property this year and close the deal in the summer, then you want to put it up for sale as soon as you possibly can. Everybody waits till the crocuses come out. But if you wait for the crocuses to come out, everybody else will be there. Fortunately, we've got a good real estate winter again. The January thaw took it all away. People are out looking. People are trying to beat this year's price. Buyers, I'm talking about. And sellers are waiting for next year's price, 23, to blossom, and so they'll get more money by waiting from last August till next March. It's probably the mix of buyers and sellers is not going to change in the seller's favor in the next 2 months. So I'm going to say, hurry up and put it up for sale. Put it up for sale, not at the February 2022 price, 10% less than that, which is more than what they were selling for in the second and third and fourth quarter of last year. And put it out regular, no holding, none of that monkey business. Nobody likes it except for the listing agent, and see what happens. Do you have a lot of showings? Do people want to buy your house? Do they not want to buy your house? Are they not looking at it? What are they telling you apart from the fact that interest rates are high? Well, interest rates are high everywhere. And after 2 weeks, maybe 2 weekends, maybe 3 weeks, then you will maybe make an adjustment. I'm going to suggest that the adjustment needs to be done on the mortgage financing, just like that chart I showed you earlier on. It can be prepared for your house or any other one. And if you're a buyer, look for the estate sale. Look for the person that was for sale in 21, in 22, and tried again, didn't sell then. Now they want to sell. Now they've run out of time. Now their window of opportunity to move to floral is not as flexible as it used to be. Now they want to sell this year. That's who you're looking for. Absolutely serious about selling. Not, I'm taking a flyer of it. Somebody who had a property rented for sale, and rented, but the tenant was giving him a hard time, took it to the tribunal, finally got rid of him. wasn't paying, finally got rid of him. So now it's empty. So now he's hurting, but he wants to sell it seriously. So buyers got to look. And as John said before, you aren't looking for one house. So what you're looking for is a willing seller who's compelled, definitely willing to sell, who's looking for a buyer, and you can be that buyer. You can solve his problem and he can solve it.
Absolutely. And I know it's a bit of a bold or gutsy move for you to list as early as possible. What's the option? You're going to wait until your neighbor sells or your neighbor lists and then your other neighbors list and then the inventory comes up. And as we've seen in previous years, especially as inventory was dwindling down and as the interest rates were low and as sales were going up, the most competitive markets were the first couple of weeks of the year. And that's why we saw a peak at February, right? Winter, pretty much ahead of a spring market. And then basically all of the sales started to decrease from that point on. So if you are selling or if you're contemplating selling, you could either wait and see, take that approach, or you can lead the market. And as Robert said, adjust the price 10% downwards and see what happens.
I'm not saying reduce the price, I'm saying reduce it from the peak.
From the peak, yes, from peak February.
Which is still above the third and the fourth quarter of last year.
Exactly. Thanks for clarifying that. So if you have any questions, feel free to reach out to Robert or myself. Feel free to leave a comment here about what you thought about this particular episode of Real Estate Chat. If you have any questions about selling, buying, investing, if you're a renter, and if you have any questions about renting, feel free to type that into the comment section below. Make sure you click on the thumbs up. Make sure you subscribe to us. Thank you so much. Please help us reach 100. To reach 100, we started with that 1 subscriber. So thank you so much for everybody who has joined us so far on this journey. We will have more of you join us and watching us on Real Estate Chat. Thank you so much. Have a fantastic 2023. And if you're looking to make a move, make sure you understand the market. Make sure you ask Robert or myself questions. Read Robert's blog, read my blog, and look at Robert's charts and navigate yourself through the market. Make that right decision. Okay. Thanks so much, and we will see you in our next episode of Real Estate Chat, where we'll give everybody a preview, Robert. Robert shared with me an article that came out actually in December of 2022, which I feel we're going to see that situation happen a lot more, right, Robert? So we're going to review what that is about, and it's about buying pre-construction. So here's a preview about our next episode. Should you be worried if you had bought pre-construction property? If you're looking to buy pre-construction, whether it's a condo or a subdivision home, should you be cautious about doing that now? We'll have the answer for you in our next episode. Thanks for joining us. We'll see you in the next episode of Real Estate Chat. Bye for now.
Bye for now.